Hi, I'm Sean Corcoran, a loan officer at Heckham Senior Home Financing. I've been asked to come speak to this class that's been sponsored by the Heckham Association. I donate my time to them to teach everybody about the Heckham for home purchase. So this class is all about the Heckham for home purchase. We're going to talk a little bit about reverse mortgage, but mainly the Heckham for home purchase. So really, what the heck is a Heckham? The Heckham, HECM, stands for Home Equity Conversion Mortgage. It allows seniors age 62 and above to purchase homes essentially at half price. Now, of course, by purchasing a home at half price, it's going to increase all your realtors' commissions and stuff like that because they can buy twice as much home for the same money. I know you like to deal in cash. A lot of seniors deal in cash, and because they don't want a mortgage payment. So we'll get into all that in just a little while. So because this is a CE class, we have to talk a little bit about the history. So the history of the Heckham for home purchase started back in 1961, and it was first done by Deering's Savings and Loan Bank up in Portland, Maine. So from there, fast forward 1969, and professor in UCLA really started getting into it and studying it. And then he moved that up into Congress, presented it to Congress. Finally, in 1989, Reagan signed it into law. So you see the slide right now, it says 1983, that presented to Congress, moved forward in 84, 87. All this is the history of it, which we have to touch on because it's a CE class, but we can go pretty fast right through it. So 89, Reagan finally signed it into law. First one was done or 88 he signed it into law. 89, first one was done. And then in 2009 and 2010, the Heckham for home purchase came about. The reason for the Heckham for home purchase is that Congress finally did something right. They took what was two transactions where the client would buy a house fully paid for, so you had closing costs once, and then they would do the refi and pull cash out of it. Now you have closing costs twice. In 2009, then the first one actually done in 2010, you had one set of transaction because the client came in with half the money instead of coming in with all the money and then taking half back out. So this class is all for realtors in the Heckham for home purchase. So let's get into how that works. With HERA, Housing and Recovery Act in 2008, as you see on your slide, ML stands for mortgagee letter. You have the 0911, which is the 11th letter written in 2009. You have 3308, 33rd letter written in 2008. So everything that we're going to cover in this class, we can back up on HUD.gov and tells all the clients and yourself any questions that you have. They can get asked Heckham for home, ask the Heckham Association, or they can call their local loan officer and they can give them all the information in black and white coming straight from the government. So here's the first question, and we're going to pause for just a moment to let everybody answer it. So when did the Heckham for home purchase get its start? Glad everybody was able to answer that question. So now, there are several types of reverse mortgage. The Heckham is backed by the FHA. But just saying that somebody has a reverse mortgage is saying like every single dog is a German Shepherd. Now, of course, German Shepherd is a dog, but not every dog is a German Shepherd. So it's also like saying all types of fruit are lemons. Well, a lemon is a fruit. Some people like lemons, some people don't. So the reverse mortgage is kind of the same. There's 3 different kinds. This one, as I said, is sponsored by the FHA, and it's the HECM is insured by the FHA, sponsored by HUD, and HECM has a satisfaction rate of 96%. And that's according to AARP and the fundings of clients that have done this loan. Personally, I'm a 100% success rate. That 100% of my clients really love this program. Speak to your loan officers, they probably say about the same thing, because this is a wonderful program for any senior that you have. They should look at it whether it works for them or not. So the HECM for home purchase really is a no monthly payment mortgage. Now, whenever you say no, a client always thinks no is no. So change that wording to optional monthly payment mortgage. By doing so, it opens up their knowledge, it opens up their ability to think of like, what actually is this program? So what I mean by optional payments is that they can go 6 months without making a payment, they can go 6 years without making a payment. There's no penalties, there's no fees, anything like that. And they can just start making a payment whenever they want. One of the benefits of making the payment is whenever you make a payment on a mortgage towards the interest or MIP, anything over $600 in the course of a year is a tax write-off. Now, of course, you need to speak to your accountant to see whether it's beneficial to take the taxes this year, possibly hold, don't even make a payment, wait till next year, and have a bigger write-off so you meet all your deductions. Of course, again, talk to your tax accountant to make sure that it's right for you, or right for your client, of course. So also the reverse mortgage, as I said, are several different types. You have the FHA, you have single purpose, and you have proprietorship. So single purpose, I basically tell your clients, don't do it unless it's absolutely necessary. The proprietorship is a private loan program that you have to look at, see whether it meets your client's needs. Sometimes they can be complicated, sometimes they can be very easy. The HECM, however, is the safest loan in America. Why is it the safest loan? Because how can you default on a loan that you don't have any payments on? You really can't. The only way to default is to not make your insurance payments, not pay your taxes. Because then at that point, if you don't pay your taxes, it's not the loan that's coming after you, it's the county saying, hey, you haven't paid your taxes. And there's several programs out there for seniors to help seniors make sure the taxes are paid on time. So now, as I said, what types of reverse mortgage are recognized by the Federal Trade Commission? So we'll pause here just so you can answer this next question that's popping up. So moving forward in this class, we're going to talk more about the HECM for home purchase and not a reverse mortgage. What I really want you to do is get the words reverse mortgage out of your vocabulary. Stop saying it. Now, as we said, there's 3 different types of reverse mortgage, but stop saying reverse mortgage. How many of you or how many of your clients have heard of reverse mortgage? Plenty of you. Most of you. How many of you heard of a HECM? Now a lot of hands just went down. So that goes the same for your clients. Ask them, well, have you considered a HECM? And that goes back to the first slide. What the heck is a HECM? So when your clients start thinking, what the heck is a HECM? What are you talking about? Their mind is open. They're willing to accept new information. That's when you talk to your loan officer and say, hey, I have this client, a HECM might be perfect for him. Excuse me, sorry about that. So if a HECM is perfect for them and they're willing to listen, that's all it takes. Of course, you sell homes, we sell loans as loan officers. So we know how to take the questions for loan and answer them in a way that turns it right back or passes it back to the realtor. So as I said, this class is about the HECM for home purchase. So let's really dig into that and let's get started. So a HECM, when you're talking to your senior and they go, well, I don't want a mortgage, I just want to pay cash. What are they really saying? I don't want a mortgage payment. Nobody really ever wants to give up all their cash. Now, if I said to you right now, all the money that's in your pocket right now, I'll give you my car. Most of you say, really, I don't have any money in my pocket. Or I've got 10 cents, I've got some change. You know what? I'll give you my car for that amount of change. Pretty much everybody would say yes. Because you're getting something of value in exchange. So no, I'm not going to give you my car for the amount of change in your pocket or money in your pocket. No, it's just an example. But the point is, you're willing to give up your cash to get something in exchange that you think is of equal value. Well, same goes for seniors. They want to pay cash just so they don't have a monthly payment. They want to get something of value back in return. So that's what their house is. It's going to go up in value, and we all know how real estate works. It goes up and down, but it continues to go up. So the HECM meets that need. They get a house, they get the perfect house that they want, and they have no monthly mortgage payment. So you can put them in a better house in a better neighborhood and still have no monthly payment. Because when somebody comes to you and says, I have $200,000 in cash, you're not thinking, you know what, I'm putting you on the greens, I'm getting you a pool, you got the view of the country club, you're right on the beach, you're thinking, let me take them to the $200,000 neighborhood. But now with a HECM, you may be able to take them to the $400,000 neighborhood. Same thing goes with, they have $300 in cash, now I'll take them to a $600,000 cash neighborhood. It's what meets the client's needs. You guys are really good at talking to your clients, getting to know your clients, and finding out what they want. Okay, then you find the house that they want. So now that's what your loan officer comes in, and they get them the right mortgage that suits their needs. And we'll touch on that a little bit later. So the HECM is if it's the right mortgage for this particular client, then let's introduce it to them, let's see if they like it, and get them right into their home. So the down payment, as I mentioned before, the $200 to the $400 and the $300 to the $600, is approximately 50% of the home value. Now, the home value is based on an appraisal, of course, but also it's based on the contract. So we have to take the lesser of the two, which we'll touch on as well. So that 50% includes all the closing costs. There's only a couple of out-of-pocket expenses, and then the rest of it can be rolled into the loan. Those out-of-pocket expenses we'll get to in a little bit later as well. So the rhetorical question of the day: if all homes were half price, how many could you sell? Hopefully your answer is all of them. Because if they're all half price, why couldn't you sell them all? So with this HECM being a non-recourse loan means only the house is held as collateral. Now, I'll tell you a quick story. Personally, I had a client, being a realtor, that was a friend of mine, and he didn't want us to make a flyer. He didn't want HECM Association to make a flyer for him. And I talked him into it finally. So he was having an open house. He had the flyer there. And right across the top it said, "Are you 62 years old? You can buy this house for this price." And it goes down through the page. And he's like, "Man, I deal with mainly 30-year-olds to 40-year-olds. That's my age group. That's the demographic that I market to. That's what I really work." I'm like, "Don't you live in Florida?" He goes, "Yeah." I'm like, "Okay, you deal with seniors then?" "Well, occasionally, but I really market to the 30 and 40-year-olds. I finally talked him into having a flyer. He had the flyer in his open house. He had somebody come in their 30s and 40s, say, "Can I buy this house at that price?" He said, "Well, are you a senior?" He said, "No, but my dad is." So he ended up selling 2 homes, not that particular home, but that client and his dad bought 2 homes because of the flyer. So it really helps because it just gets the word out. It gets the conversation started. So as long as you can get the conversation started, people are willing to listen. So when I say non-recourse, it means only the house is held as collateral. So the market does this, we all know that. Well, 2008, we had the market do this. Big, huge crash. But the people that did a HECM at the beginning of the bubble, and they cashed out, when the market did this, their home value was way down here, but they did the cash out up here. So they owed a lot more than their house was worth. You know what? They won. They won because if they cashed out and they gave their house to their kids at that point, or they decided to move at that point, their home value is way down here. The great thing about the HECM is that that's all that they owe. All this money that they put in the bank is theirs. They can buy the house back, their heirs can buy the house back at this new price. And then if it's upside down, they get a 5% discount to what it's worth, not what is owed. So that's another good way that you can win with this loan. And if the loan is doing this and the home value is doing this, well, guess what? You win that way too. But if it does this, you won again. This is a great way for your clients to plan for their financial future. And I'll touch on financial planning in a little while in the slides. But as I said, this loan is the safest loan in America. So here's the next question. Can borrowers of a HECM or the estate ever be required to pay back more than the value of the home? So I'll pause right here and give you a chance to answer the question. All right. All right, thank you for answering the question. So now the big question is, when is the mortgage due? So the mortgage is due when the last homeowner on the mortgage is done with the home. What I mean by that is we can put up to 4 people on the loan. Now, if none of them are married, they all have to be above 62. If they are married, I can put one above 62 married to somebody under 62. That's called an under-over. Or I could put two people that are over 62 as long as they're married to the two under like this. But these two can't be married and put like son and daughter on if they're not 62. They have to be married to the one that is 62 or above. So now all four people are on the loan. It has to be at least one of their primary homes at all time. So when the home is done and the last person is done with the loan, that's when the mortgage comes due. Now, FHA does have a little tiny fine print saying the mortgage also can come due when the youngest person turns 150. Now, I don't know about you, but I don't know anybody that's turning 150. So we're not going to worry about the 150 age. It's just when is the last person done with the home. So if they pass away, of course they're done with the home. If they decide to move, they're done with the home. Now if they go into a nursing home, unfortunately it happens quite often, but if they go into a nursing home, they're only there for 3-4 months and they come back home, everything's fine. If they go into a nursing home for over a year, odds are they're not coming back home. Really, statistics say if they're in the nursing home for 8 months or more, then they're not coming back to their house. At that point, why would they even want to hold on to their home? Because they got to pay for the nursing home. Sell your home to your kids, sell your home to your neighbors, sell your home to anybody. Take that cash to help pay for their care. So when they're last done with the home is when the mortgage is due. So, of course, as I said, the mortgage can also come due if they don't pay their taxes, HOA, and homeowner association if they have one. And property taxes, of course, and association dues. Now, who is eligible for the HECM? So eligibility requirements. As I just said, at least one of them on the loan has to be 62 if we're doing a married couple. Their spouse can be any age all the way down to the age of 18. Now, think about that. I'm not telling you which one's older, whether it's the male or the female. Male, everybody goes, whoo. Female, they go, what a cougar. So either way, the other spouse can be all the way down as young as 18. The highest that HECM Senior Home Financing has had is they had a 73-year-old married to a 35-year-old. Now think about that. Now they'd been married for over 2 years. They touched base with them. They're still married after 5 years later, but a 73 to a 35-year-old. They're doing it so she could get a green card, but the big difference is whenever we do a loan like that for an under or over, we don't go to the 73-year-old's age. We have to calculate on the younger spouse's age. So instead of having less than 50% down payment, because her age was 35, they had to put down a lot more. And we'll get into those numbers a little bit later of exactly how much do they have to put down at what age. And I'll have some good examples for you in the slides coming up. So also besides the age limit, they have to have the right to live in this country. Now, what gives them the right? Well, of course, if you're a citizen, you have the right to live here. If you're a Canadian, you actually have the right to live here. But also, what if you had a green card? What if you have a working visa? For those, you also have the right to live here. Now, a work visa sometimes is only good for 6 months, sometimes it's good for 6 weeks. You can purchase a home with a work visa, but the thing is, at the end of 6 weeks or 6 months, whatever that visa is up, the mortgage is due because you no longer have the right to live here. So if that were the case, this would be an expensive loan, as would any other loan out there, because you have all the closing costs. You're only there for 6 weeks. Why don't you rent a place? But if it's for 6 months and they're trying to get their permanent visa, well, then maybe this might be the loan for them. But you have to be very careful, and it's the client's choice, of course. And as I said, everything's on HUD.gov, so we can back up everything we said. U.S. citizenship is not a requirement, as I went over the couple examples of what you could do to live here. So because I went through all that, here's the next question. What is the youngest spouse's age that can be on a HECM? So go ahead and answer this question. So great, as I said, 18 years old is the youngest person can be on the slide, so thanks for answering that question. Now the other eligibility and requirements for this loan. So we covered the age, we covered if they're a citizen. Now let's cover the property. What property is eligible for this HECM loan? So if it's a single family, absolutely anywhere, any US territory, any US state, DC, no problem. When I say territory, I'm including Guam, Puerto Rico, Cayman Islands, the Virgin Islands, because we own part of them, the British owns the other part, but anything that's a US territory, you can do this loan in. Now, of course, you have to have a loan officer that's licensed in that state or territory to be able to do it. So, as I said, single family homes. Now let's get into a little bit, those are the most common, of course. Let's get into a little bit more. So, new construction. New construction is eligible, however, they must have a CO before the loan can be accepted, before the application can be accepted. Now, HECM Senior Home Financing has done it as little as 7 days on new construction. You can ask your particular loan officer how fast they've done it on a new construction. Now, everything has to be lined up just right for reclose in 7 days. Usually a HECM loan takes about 30 days. We always tell the client 30 days because we want a little extra. But about 21 days is average close. 30 days, okay, that's still good for the industry. If you're going past 30 days, think about it. So, new construction, as I said, a CO must be issued. Once that CO is issued, we can always do the pre-approval, we can always do everything right up to that point, but that's the day it's turned in, and then it's a rush. Get it done. So duplexes, triplexes, quads, all of those are good. Now, on the duplexes and triplexes, quads, we'll get into that in just a second, but I want you to keep that in mind because that's a real moneymaker for your client. So other homes, condos, they must be FHA approved. Single family trailers. Now, if they own the land, you're good. If they don't own the land, even though FHA say it's possible, good luck. I've dealt with companies that are specifically deal with trailers, mobile homes, sorry. I know people like mobile homes instead of trailers. So they deal specifically with mobile homes and they can't get it done unless the client owns the land. So that's your manufactured home. The FHA says it must be move-in ready. It cannot be a fixer-upper. Now that last slide, I really went over line by line because it's important to think about what homes qualify. So if you have the home that qualifies, where do you get the cash? It has to be their money. So you can't borrow money to borrow money. You can get it out of CDs, you can get it out of IRAs, you can get it out of annuities, you can get it out of a life insurance plan as long as you are doing a withdrawal, not borrowing. You can take it out of savings, wherever you want. Now the great thing is FHA has passed a rule. It used to be you can only get $5,000, then went to $10,000, then went to $25,000. Now you can get any amount from friends or family. They can, as long as it's a gift, and I gotta get a gift letter saying, hey, this is a gift, it's not a loan. Then it goes to your client. comes to your loan officer, and then we get them in the house. So where can the money not come from? We'll get into that in just a second, but let's answer this question real quick. How much of the down payment funds can be a gift from friends or family? So hopefully everybody said 100% on that. Because as I just said, it can come from friends or family, any amount according to the FHA, as long as you have the gift letter. So now, where can the money not come from? As I said, don't borrow money to borrow money. It doesn't work. You can't take it off your credit cards and say, whoa, whoa, because we do have to pull the credit report and we say, you just borrowed all this money, you just increased your debt, you increased your monthly payment out, and now you don't qualify. You can't borrow money from your friends, you can't borrow money from the bank, you can't borrow money from another house that you have. Now, I say that, but there's always ways around certain things. So if you borrow money from a house, and you borrowed it from a different house, and you borrowed it over the time period of when I'm going to look at it, maybe you can use that funds. Now, how do you do that? Well, of course, you're supposed to have that loan for so long, so it shows up on your credit and shows that you can make the monthly payments, and then you can use that cash for whatever you want to buy another house. So your family member, if they took a loan, I'm not going to check their credit, and your loan officer's not going to check their credit. They can give a gift from the son to the parents, or daughter to the parents, doesn't matter which way, and it can be a gift. Now, I'm going to check the bank statements of your client for 2 months. I'm going to check the bank statements from the giftee, or gifter rather, of 1 month. So if they borrowed money over a month ago and it showed up on their bank statement, they've had it in their bank for over a month, and then they give it to their parents, and I say, whoa, where'd you get this money? Oh, my son gave it to me. Okay, well, I need to see your son's bank account. Oh, you've had that money for I don't know how long. As long as it showed up that full month on that bank statement, it's a gift. Now, gotta get the giftee letter, don't forget that. This is a gift to my parents for this much money, boom, we're good. Let's go have a closing. So again, don't borrow from your 401, don't borrow from IRA, don't borrow from your neighbor, don't borrow from anywhere. Don't borrow money to borrow money. Doesn't work. The FHA will automatically say, doesn't work. So I think I covered that one, beat it like a dead horse. So moving on, as I said earlier, there's 2 out-of-pocket expenses. What are those expenses? You have your appraisal, which currently is running at about $500. May update in your area, may be different for your homes, stuff like that. If it's $1 million home, more than likely you're looking at a lot higher than $500. But so it really depends on where your home is, how much that appraisal is going to cost. And then you also have HUD counseling. Currently, it's average about $150. Now, I know some of them go as low as $99, some of them go $199. I personally tell all my clients, call around several different ones, don't pay the high price for something you get for a lot lower. But if it's the first one they contact and they say, well, I just want to get it done, of course, that's up to them. Your loan officer is required to give them a list of HECM approved counselors. It has to be so many in the state, has to be so many out of the state. They're allowed to call anywhere in the country. They're all overseen by HUD. I actually called one in Alaska one time for a deal down in Florida. So anywhere in the state, as long as the counselor is approved by HUD, we're good to go. The other costs, the closing costs, which you being realtors are quite familiar with, your FHA fee, which is MIP. You call it PMI. We call it MIP because we do things in reverse in the HECM world. You get it? Reverse mortgage? Okay. So then you have 2% of the MIP, of the home value. You also have your doc stamps, closing stamps, title, right down the line, all the regular closing costs. So those go into your purchase. As you can see on the slide at the bottom, the example, the max purchase price that we can base our numbers on is $765,600. Now, keep that in mind. It's always changes. It always usually goes up because inflation. So in time it's going to go up. So currently it's $765,500 or $600. Sorry. So the origination fee is based on the purchase price, but it caps out at $6,000. So you might not care. I'll explain the origination fee real easy so you can tell it to your clients if they're worried about it. It's 2% of the first $200,000, then it's 1% thereafter, and of course 1% gets up to $400,000. You're capped out at $6,000. So anything above $400,000 and up doesn't charge anything extra on the origination charge. So saying that and how much all your origination charges are, doc, stamps, deed, everything rolled in together, which is more expensive? Paying cash for a house or financing a house? Of course financing, because of closing costs. So now, which is more expensive? A HECM loan or a VA loan? The closing costs are about the same. Usually the VA loan wins out just a little bit because veterans have other certain benefits, stuff like that. But which is more expensive, conventional or FHA? Well, FHA. Which is more expensive, FHA traditional forward loan or FHA HECM loan? They're about the same, except on the HECM you have the MIP, mortgage insurance premium. So we'll get into those a little bit more as we go into the numbers. But the HECM in financial planning is an awesome deal. As you get into financial planning, if you've talked to any financial planners, I'd say about 6 years ago, financial planners were like, no way, I don't want to know about that. Well, there's a Dr. Wade Fowle who did his financial studies on the HECM for home purchase. And he did his doctorate on it. He is a doctor of financial planners. He has gone so far as to say, if you're a financial planner and you don't at least talk to your clients about a HECM, you shouldn't be a financial planner. You're taking the biggest asset of someone's life and taking it out of their financial plan. He said, don't do that. Keep it in their financial plan. The HECM may work, the HECM may not work, but at least you should look at it. Now, the HECM, in his study, he took 6 families, did 10,000 scenarios. They call it a Monte Carlo scenario, where he did so many scenarios per family. And 95% of the time, the client gained net worth by doing a HECM. Now, how can you gain money by taking a loan? Well, if you do it properly, unlike going to Vegas, you take half your money out of your house, you go to Vegas, you put it all on red, guess what? You may end up being in the red. So, taking crazy stuff out of the plan, you take half the cash out of your house, and let's say maybe you buy a smaller house with that cash, pay it all cash. You still have your primary home, the value is here, you took half out, you took this cash, you bought another house over here, so where's your monthly mortgage payment? You still don't have one. You don't have a monthly mortgage payment on the HECM here, even though you took half the cash out. You don't have a monthly payment on the new house because you paid cash for it. But now you find a renter. And now you have cash flow coming back. And you can either pay back the HECM or put it in your pocket. So a lot of seniors are going to say, well, I don't want to deal with tenants. I don't want to deal with all that. Well, you as realtors know plenty of property management companies. You deal with the property management, therefore you got another sale over here. Now you've set up the property management, so you're getting paid that way, and the client's getting an income, and they don't have to worry about it. And guess what? If the tenant moves out, they still don't have a monthly payment because they paid for it in cash. So now you have cash flow, which in any age, but especially a senior, cash is king. So after we went into the financial planning, did the Monte Carlo scenarios, as you can see on the tax slides, tax-free 10-year payment. There's different ways to set up the HECM. If you do it on a variable rate, you can have the HECM, instead of buying a cash house over here, you can have the HECM pay the client every single month till they die. As long as they're in their house, they get a payment. Now, if the housing bubble does this, guess what? They still get a payment. It's based on whatever their home was at the time they closed the loan. So then they get a payment every month for the rest of their lives. Now, that's the 10-year payment. You can also have a certain fixed period, they call term payments, and say, you know what, I want to get this much payment for 5 years, 10 years, 20 years, whatever it happens to be. And then calculate it that way, and they get that fixed payment for that long. Now, of course, a lifetime payment would be this, a fixed payment would be this, because they're shortening the time period. So keep it in mind, it may work for your client, may not, but 95% of the time, they gain net worth. 95% is a pretty strong percentage. So in most traditional mortgage payments are 10% primary interest for the first 10 years. Not 10% interest, but 10% of the loans are paying for the first 10 years, mostly interest. The average is it takes 17 and a half years on a 30-year mortgage, based on the interest rate between 4 to 6%, 17 and a half years to get to the halfway point where you're paying equal principal as you are interest. Then after that, because now each payment is more principal than interest, your loan gets paid off quick. But the first 17 and a half years, you're paying more interest than principal. Now there's ways to cut your loan short by paying extra the first year. If you pay double payment the first year on a standard 30-year loan, you actually cut 5 years off the end of your payment loan. So that's a little trick loan officers can teach you as well, going through the numbers. But by shifting the numbers and putting it into a HECM loan, where it only accumulates a little bit of interest at the beginning, rather than all the interest at the beginning, depending on how long the client's going to be in the house, they actually save a ton of money. So how to use the HECM, as I said, take money out of here, borrow this house over here, take the money out of here that's right now about less than 3% interest on a variable rate. They're used to the stock exchange. Okay, playing the stock exchange. How much money do you get out of the stock exchange? Oh, you're getting a return of 5%, 9%, 12%. Of course, the stock exchanges vary. It's a gamble. Okay, they don't want to do that. Take that example away. What about Social Security? Now, you're 62, you're eligible for Social Security. Instead of taking money out of your home and doing the HECM, or instead of cashing in your Social Security and doing it first, don't touch your Social Security yet. Don't activate your Social Security, because once you start it, it's locked in, period. So if you hold on your Social Security and you take money out of the house at 3%, your Social Security goes up by 4% per year. Sorry, it goes up by 8% per year on an average of 5 years. Now that math doesn't add up, but it compounds. You get a 50% increase in Social Security over 5 years if you don't touch it. So imagine your Social Security is here and you wait, it's up here. You borrowed money at 3% to make 8%. Okay, now you cash in your Social Security, tell them, okay, start making me payments. You can turn around and pay back the loan if you want, but you don't have to. Now, if you pay back the loan, here's where the financial planning really comes in. If you're on a variable rate, every payment you make, whether it's 1 penny, $1,000, $10,000, whatever it makes, one, of course, pays down the loan, but two, it goes into a line of credit. That line of credit you can re-borrow at any time and no fees to take it out. So it's a great financial plan for your clients. So we're going to skip a couple of the other financial planner information. As you can read through the slides, pretty easy, it's pretty standard. They still have no monthly mortgage payment. Again, change that no to an optional monthly mortgage payment. They have optional monthly payments. What could be better than that? Even if you had a regular loan and you have 10 years left on it, you've been in the house for 20 years, you as a realtor may consider this. You know what? I make good money, but sometimes my money's up here, sometimes my money's down here. If you switch your house at 62 to a HECM loan, and you have a bad couple months and you don't have any house closings, you could be in trouble depending on how many closings you usually have. Hopefully you're doing well. But if your home is in a HECM, skip the monthly payment. Skip 2 months. Then you have that closing, you say, you know what, I'm going to start making regular payments again. You can do that. There's no penalties. Skip as many months as you want. There's no penalties. So that's the great thing about the program. The bank's not going to come knock on your door. Hey, you missed a payment. By the way, you have a late fee. There's no late fees. So that brings us to the next question. How can having a HECM during a financial crisis be beneficial? So go ahead and answer that one. I'll be right back. All right, thanks for answering that question. Remember, answer all the questions, that way we can get you CE credits, so I appreciate that. So this next, as you see on the slide, what's next? What's next is a break. So answer some phone calls, go to the bathroom, go get a drink of water, snack, whatever you have to do. I'll see you back in 5 minutes. Well, as I said, what's next? So what's next is identifying your senior client. This program, we're allowed to discriminate. Shh, don't tell anybody. Okay, well, you're allowed to tell them. Please tell them, because one person has to be at least 62 years old. Remember, their spouse can be any age all the way down to 18, but one of them has to be 62. So you're allowed to ask, can I ask your age? They go, why? And you say, well, I've got this great program that may suit your needs. It's called the HECM for home purchase. So once you've identified at least one of them is 62 years old, now you want a loan officer that specializes in the HECM. Because not every loan officer does a HECM. I'm not holding anything against anybody that doesn't. Because the HECM paperwork is a little bit different. We still use the HUD 1 rather than the financial assessment. So TRID, everybody knows what TRID stands for, right? You know what it stands for in the HECM world? The reason I drink. That's TRID. Now, I know that's not really what TRID stands for, but in the HECM world, we don't deal with TRID. We still deal with the HUD 1. It makes it nice and easy, it makes the paperwork easy. Now, some of the forms that we do between us and the title company, when I say we, I mean your loan officer, of course. Between your loan officer and your title company, is we still use the old forms. Now, if your title company isn't familiar with the HECM, you're going to have a delay in closing. You're going to have a very upset customer. Who do they blame? You. And then who do they blame? Your loan officer. So even if it's title that messes it up, they don't care. No, title is just where we go sign a paperwork. They blame you or they blame your loan officer. Let's have a smooth closing. Let's have a happy customer. Because we all know what seniors have. A lot of time. What do they do with that time? They talk. They talk to their neighbors. They talk to their friends. They talk to their cousin that lives still up in New York. If you live anywhere in the East Coast and you're going to move in retirement, where are you moving to? Florida. Florida's known as the retirement state, the Sunshine State. So if you live west of the Mississippi, where are you moving to in retirement? Oh, California, Arizona, New Mexico. They have choices. Sometimes Texas, of course, too. But they have choices. If you're on the east of the Mississippi, oh, I'm moving south of retirement. Where are you moving? I'm moving to Florida. Where else would you rather be to know about this program? So the HECM specialist, as I said, will provide a list of housing HUD counselors. Then take your client dream home shopping. Show them the homes that they really want, because now they can afford it. As I said earlier, that you can take somebody with $200,000 in cash and you can take them into a $400,000 neighborhood. Now, of course, we want to do what's right for them. If all the money they have in the world is $200,000, don't take them to that $400,000 neighborhood, because what happens each November? Exactly, taxes. Taxes come due. So if $200,000 is all the money that they have, and they can't afford to pay their taxes on a $400,000 home, well, of course, don't put them in a $400,000 home, because that's the only way you can default on this loan. Just don't pay your taxes, homeowner association, or any dues. So you got to have insurance on the house and HOA taxes. But take them to your home shopping, write a contract. Now, when you write a contract as a realtor, what do you have to mark on your contract to show that you want to do a HECM loan? Real simple. That little box that says FHA, boom, done. Now, here's special instructions for all you realtors. Do not, on your contract, mark FHA and then write in HECM. Because going back to the very beginning, what the heck is a HECM? Don't scare the seller into picking somebody else's contract because they don't know what a HECM is. Mark FHA and just put down the amount that they want to put. If they're putting 50% down, put 50% cash. If they're putting 75% because they want to, not because they have to, put 75%. If we run the numbers and they only have to put 40% down, put FHA, 40% cash. And it's not up to the seller to wonder why they want to put 40% cash. It's up to the buyer. And why 40% cash? Because they chose to. They chose to use a HECM. So wouldn't it be lovely to put only 40% down and you own the house with no monthly payments? So just let that resonate for a while. And as I said, approximately 4 weeks we're having a closing. That's kind of industry standard. Now, as I said before, a lot of companies do it less, 21-day average. Not mentioning any names. But talk to your loan officer, see how fast they can usually get a HECM done for you, HECM for home purchase. Now, of course, refis can come into play, but do you guys get paid if a client does a refinance? No, of course, right? Because you didn't make a sale. So you go into somebody's home and they say, you know what? All my memories are here. My kids grew up here. They've grown and moved away. But my spouse has died. Usually it's the male, passes away first. No hard feelings. I'm in that group too. But usually the male passes away first. And the wife is left in this house. And she's been there so long and she wants to stay, but she can't afford to take care of the lawn. She can't afford to maintain the house. You go and you talk to her and you say, well, okay, well, what? We can list your house. She said, but I really want to stay. So after talking to her, she decides she doesn't want to list the house, even though it's a financial burden for her, and it's making her money go down a little bit each month. She doesn't want to sell yet. So you just lost your sale. Think outside the box. Talk to her about a HECM refinance. She pulls the cash out of her house. She's been there 30, 40 years. The house may be paid off completely. But she pulls the cash out of the house. Now she has cash to do what she wants. Now, financial planning, we talked about earlier. Go get that other house. Pay for it in cash. Now she has cash flow. You have fixed her problem. And you got a sale over here. The house that she bought in cash. You still made a commission. But more importantly than that one sale for the smaller house, you got a happy client. Because that senior client is going to say, oh my God, she really cares. He really cares. He took care of me when I needed it. If you want a realtor, you go talk to this person right here. They will help you. So you fixed her problem, you got her in a house, you made a smaller sale, but guess what? Now you have referrals. Referrals are important. They keep you alive, they keep you in business, they keep your loan officer alive, they keep them in business. So use that referral, help her stay in her house, help her make that money. So how do they qualify for this loan? So before, back when it very first started, in '69 when I went to Congress, in 2000, in '89 when Reagan signed, '88 he signed it into law. '89 was the first one that was done. So I keep saying '89. So '89 was the first one that done. If you were alive and breathing, you qualified for this loan. You're 62 and you're breathing. Sign this dotted line. Guess what? Here's 70% of your equity out of your house. All of it here in cash. Boom. Well, guess what happened? They took that 70%, they went out and they spent it, they gave some to the church, they gave some to charity, they gave some to their kids, they gave some to this, they paid off these bills, and all that money was gone. And what do you think they did? We'll give you more money. And Lana said, I can't. I gave you 70% of the equity out of your house. It's still your house. We didn't buy your house. You still have 30% equity in it. All you did was take a loan, but you took all the cash out. There's no more to give you. So because of that, and they didn't pay taxes, well, now the government, the local government, came and said, hey, You still owe taxes, but I don't have any money. Well, give me more money. I can borrow more money from my house. No, I'm sorry. You took all the money out you could. So in November, taxes come due and take some time. And of course, now they're getting the eviction notice because taxes on their home. Not because of the loan, but because of taxes. So in doing that, the reverse mortgage, notice I said get those words out of your mouth, out of your vocabulary, but the reverse mortgage got a bad reputation because they kick seniors out of their home. Headline on newspaper, senior loses her home due to reverse mortgage. Read through the article? No, she didn't pay her taxes. This is the safest loan in America. You can't default. Because all you have to do is pay your taxes and insurance and HOA if there is one. So over time, as moving forward, since Reagan signed it into law, they found out that people were spending all their money. You're putting a bandage on a tourniquet, what needs a tourniquet. What I mean by that is they're bleeding cash and they say, oh, well, let's take equity out of the house and help pay some of those bills. Well, they didn't pay the bills. They don't know how to manage the money. So they spent all that money and now they're still bleeding cash and they used up all their money. They can't stay in the house. They were living beyond their means. So in time, a financial assessment was added. So that financial assessment, we look at the client's credit. I don't care about their credit score. Neither does your loan officer. They don't care about their credit score. I actually did a loan myself for a client that they were married. One had a 350, one had a 356 credit score. But they still had the cash flow and we got the loan done. So I'd never seen a credit score that low before, but between the two of them, the married couple, they had 46 things in collections. But they still had enough cash that we got the loan done. So as I said, the financial assessments come into play. The way that works is I'm going to look at the if they're single, then a single person must have $529 after their monthly mandatory expenses are paid. Now, what's monthly mandatory? When I pull their credit and I say, oh, you've got this credit card, this credit card, this credit card. Those are monthly mandatory. They're showing up on your credit. Oh, by the way, you have a student loan, and you'd be surprised how many seniors still have student loans. You have this loan, you have this, you have a car note. All these are showing up on your credit. They are mandatory, monthly mandatory. But what about your groceries? What about gas for your car? What about your telephone? Cell phone, landline, whatever it happens to be. More often than not, it's a cell phone, of course. Some seniors still have landlines. But those are not considered monthly and mandatory. They don't show up on the credit report. So that's where that $529 comes in. If they can pay everything on their monthly mandatory bills, including taxes and insurance for the home, and HOA if there is one, of course, and still have $529 to pay all the other incidental bills, then they qualify. Now, same thing goes for a married couple, but it's not $529, it's $886. If after all their monthly mandatory bills are paid and they have $886 left over, they qualify for this loan. I don't care, when I say I mean your loan officers, we don't care about debt to income ratio. If they have $20,000 a month coming in and they have $19,000 a month in expenses, they qualify. Because remember, a married couple is only $886. So debt to income ratio, I don't care. Your loan officer doesn't care. Sounds pretty good, doesn't it? So income will be verified, Social Security, pension, whatever happens to be, if it's annuity. If they just started it, then a little bit more paperwork goes into it because I gotta make sure it's gonna keep going, when to start, stuff like that. But really, I've done so many loans where only the Social Security is enough to qualify them for the home. Because if they don't have those other monthly mandatory bills, and their Social Security is $1,500, well, man, only one person's Social Security qualified with the two of them. Now, I get this question a lot of, well, once they do the loan and one of them passes away and their income drops away, do they have to leave? The answer is no, of course not. A loan, like any other loan, because what is a HECM loan? It's a mortgage like any other mortgage out there, except we have optional monthly payments. So if one spouse passes away and the other spouse is still living, but we did it while they were there, they still get to stay in the house. Now remember the fine print, 150 years old, but they still get to stay in the house. So as long as they're there, they're fine. Pay your taxes in HOA. So the sales contract, as I said, mark FHA box, check it off. Contingency for home inspection. Now, they have to have an appraisal. They don't have to have an inspection. Now, of course, I recommend one, make sure the house is sound, but they can just go off the appraisal and that's it. So, of course, FHA, a mandatory clause, and the buyer chooses the title company, ideally. Not all the time, of course, but ideally. Because remember, as I said earlier, you want a title company that is familiar with a HECM. Pretty much all the title companies out there say, well, yeah, of course, we've done a HECM before. We've done, yeah, the last one was about 6 months ago. Oh, so your last HECM deal was 6 months ago. Deal with the title company that understands the HECM a lot. We want satisfied clients and referrals. When I say we, I mean our industries. Real estate industry, mortgage people, and realtors alike. We want satisfied clients because we get referrals, we stay in business. It's all about staying in business and helping your client. Do the right thing for your client, more referrals will come back. So from there, as I said, we still use the HUD-1. We kind of covered everything on this slide, little bits and pieces along the way. As I said, TRID, do I need to say it again? The reason I drink. No, just kidding. So the addendum. If you have an addendum on your contract, don't worry about it. This is like any other loan, any other contract. Just make sure it's marked FHA. You don't need to write HECM in there, just FHA and how much they're putting down. So some clients don't even require how much you're putting down. Just make sure that FHA is box is check marked. And if you have an addendum, no worries. We'll easily handle it, take care of it. When I say we, of course, that's your loan officer. So that brings us up to the next question. Which boxes should you check when a HECM is used to purchase a home? Now, I think I nailed it. I think I told you a couple times, so go ahead and mark that answer real quick. So hopefully everybody answered that last question. As I said, I nailed it. I gave it to you like 3 or 4 times before I even asked the question. Remember, answer the question so you get your CE credits. If you're just taking this class to learn knowledge, please try to answer the questions anyway. That way, just make sure that your knowledge is right on track. So the HECM for home purchase transaction summary. As I said earlier, we're going to get into these numbers and how much the person has to put down. The average age that someone does a HECM is 72 years old. You know the average age for a realtor in Florida? 63 years old. That's the average age, so think about that. So the numbers for a $200,000 house. At 72 years old, because as I said, that's the average, you're putting 48% down, less than 50%. Now, that number is calculated on a 3% interest rate. On the fixed rate, we're looking at right about 3% right now. On the variable rate, you're looking under 3%. So the lower the interest rate, the more money that I can lend them. So obviously, if I can lend them more money, it's less money they're coming into the transaction with. So all these numbers we're going to base on what it was when I made the slides at 3%. Moving forward from there, so somebody that's 72 years old can buy a $200,000 house for only $96,750. Now that $96,750 includes the closing costs. All the closing costs are rolled in except for those two out-of-pocket fees that we went over, which is the counseling and the appraisal. Now, if they are buying a manufactured home, there's a couple other closing costs to go with it, because we have to have an engineer come out, make sure that it's mounted to the ground properly. That's about $350, and that price unfortunately is starting to go up. But we're not going to talk about the mobile home, the modular homes, trailers. We're going to focus on the single family home, multi-family home, condos, townhomes, clusters, everything like that. Only has those two costs. So that's the $200,000. A $300,000 house, again, 72 years old, $140,750. Again, based on the 3%, including the FHA fee, including the origination fee, including all the third-party charges, tax fees, document stamps, everything that has to be filed in the state. So all those charges are rolled in. $300,000 home, they're only looking at 47.6%. So you see, as the home is going up, the percent is slightly going down. So rolling into a $400,000, you're at 47.1 at 188. Now, $500,000 home, at that $400,000 mark, there's something special that happens, if you remember from earlier. So $500,000 home, they only need 46% and $233,275. Now, what's that special something that happens at $400,000? Now, if you remember when I said the origination fee, you don't have to remember this, but I touched on it, that for the first $200,000 it's 2%, then 1% thereafter up to $400,000. After $400,000, it's capped out. So the origination fee stops at $6,000. Going higher than that, from $400 to $500 to $600, $700, there's no added origination charge. So also dealing with your loan officer, if the client is very upset about the origination charge, there's ways to get around that. They can raise the interest rate, it can be built into loans, stuff like that. So don't let them get hooked up on the origination charge. But the easiest thing is, if it's up front and is rolled into the loan, nobody's really happy about that, but they understand because it's all been explained from the very beginning. Your loan officer tells your client all about this loan. Then they agree to this loan. Okay, to agree to this loan, they have to go to counseling. The counselor is overseen by HUD, and they tell the client all about this loan all over again, line by line. Loan officer is going to give them a proposal, comparison page is what they call it. And this is what it is if it was fixed, this is what if it was variable. You give them three options and say, okay, here you go. They give those same exact numbers to the counselor. The counselor and the client, without the loan officer on the phone call, loan officer is not allowed to be on the phone call, go over all those numbers, line by line, to see exactly what it is, and they explain to them. If the client has any questions, they can ask the counselor. Usually that phone call is about a half hour to 45 minutes. One person that I did took 4 hours. Why did they take 4 hours? And I was like, wow, 4 hours. I've never heard it taken that long. He's like, well, I asked the counselor every question that you and I went over. I want to make sure that you were telling me the truth. I said, did I say anything wrong? He said, no, you didn't. Everything I asked, the loan officer, the counselor confirmed that you were telling the truth. I'm like, okay, why did you take 4 hours? He said, because I wanted to understand it 100%. I know this loan. I wouldn't be telling all my friends about this loan now. But he asked the counselor every single thing about the loan, and he confirmed that what I had told him was 100% correct. And as I told you, we can back everything that we're saying up on HUD.gov. If you want it black and white, you want to present it to your client, you want to read it through yourself, we can find it for you. Send it to the HECM Association, send them a request, or your loan officer a request. They'll usually, what they'll do is they'll call the person in the office and say, hey, can you look this up and email it to this person? Because just like you, most of your time, if you're making sales, is not in the office. It's out talking to your clients. Same with the loan officer. Now, you and I both, we can't do our job without the support of our team. So if you have a good team behind you, it makes your job a lot easier. That team would look it up, get it right to you, you get it to your client, bam, we're all happy. So as I said, 600, 700, the max of this loan amount that I can base my numbers on, currently, when the slides are made, are $765,600. Now, if that's the max, can a client buy an $800,000 home? Yes, of course, exactly. So since this is an FHA loan, they're allowed to buy any amount that they want. They just have to pay dollar for dollar till it comes down to that limit. And then I base my numbers on that limit, and we're happy. So going from there, as I said on this slide is explaining what I just went over. They're allowed to buy anything above that $765,600 as long as they pay dollar for dollar to get it down to the lending limit. That's what they call it, a lending limit. And then we base our numbers there, and we see how much the client still has to come up with out of cash. So an $800,000, as I said, there's the example. They're still only paying 48.6% for an $800, dollar for dollar for that little bit. And then we base our numbers on this much. They're paying this. Boom, we're having a closing. They didn't even pay half price. So $1 million home, same thing. Now, $1 million home, they did pay, darn it, slightly more than half. So on $1 million home, a 72-year-old only paid $589,675 based on a 3% interest rate. So if you're buying $1 million home for $500,000, let's just round the numbers off. Homes appreciate at what percent? On average across America, it's 4% per year. So the loan increasing at 3%, but the home increasing at 4% on average, of course. We all know it does this. So you're increasing your net worth. The bigger the home you buy, the more increase you have. So by all means, buy the home that you can afford. That brings us up to our next question. Can a person purchase a home in excess of $1 million using a HEC home? Now, I showed you the $1 million example, but can they go over $1 million? Answer the question, I'll be right back. All right, thanks for answering that question. Again, answer all your questions so you can get your CE credits. Now, this leads me up to the demographics and the numbers. I'm a numbers guy. Most of your loan officers are too. I love numbers. So the demographics of this loan, now these numbers and demographics are based in Florida, but the seniors buying this loan, the seniors doing this loan, the seniors that are moving to Florida and stuff like that, 10,000 people per day in America turn 62 years old. Now that's the average. The current number, as of 2 weeks ago when I checked it, was 11,860 per day. But just based on the 10,000 per day. So 10,000 people per day turn 62. according to the Florida website, 1,000 people per day move to Florida. Now, of course, not all of that 1,000 are 62 years old. I myself moved to Florida, and I'm not 62 yet, even though I'm getting there. It was the gray, see? But no, 1,000 people per day move to Florida. And we went over earlier, and if you live on the East Coast and you're retiring, you're moving to the Sunshine State, you're moving to Florida. Where would you rather be anywhere in the country to know about this loan but Florida? You live in the prime area to do this loan. So 24% of the home buying population are already 62 and above in Florida. And if you think 24% is good, well, think about this. 35% of all the homes sold in Florida last year were sold to seniors. So if you're not dealing with seniors, you should really consider starting. If you are dealing with seniors, here's a great tool so you can start marketing to seniors. Talk to the HECM Association. They're the ones holding the class. HECM Senior Home Financing is sponsoring it for you. So this class is currently a free class for you. So take the class, spread it around to other realtors, get everybody knowing about this loan. This loan will help you sell more homes. So 40% of the US population plans on moving at least one time in retirement. They plan on it. Now you may have moved for your job, and now you're retiring and you want to move next to your grandkids. Help the family out, help your kids out, help take care of the kids, help watch them. You just say, you know what, I'm done with my job up north, I'm going to the sunshine, I'm getting out of that snow. Whatever the reason happens to be, they plan on moving at least once. Now, have you heard of the Villages? The Villages is here in Florida. It's their own city. It is the largest 55 plus community in America, and it's the fastest growing 55 plus community in America. And once you move into the Villages, on average, you move 2.5 more times after moving in. So that's almost 3 sales after moving in. 4 sales total. And you have to be 55 to move in. So seniors are definitely buying and selling homes. So definitely consider the senior market and improving your sales, improving your commissions. Of course, doing what's right for the client. So 70% of seniors, 77% of the wealth in this country are controlled by seniors. In other words, cash buyers. Now again, if they're a senior and they want to pay cash for the house, what are they really telling you? I don't want a monthly payment. Nobody wants to give up their cash, but they don't want a monthly payment. Talk to them. Have you heard of the HECM for home purchase? Let me let you talk to the specialist, being your loan officer, that knows this loan. It's a loan. I don't want a loan. Wait. Talk to this guy. I think it might be a good product for you. I'll make a deal with you. I don't sell your homes. You don't sell my loans. And that should be every loan officer's motto. We're good at our loans. We know our loans. Whether it be a HECM loan, whether it be a commercial loan, whether it be a VA loan, FHA loan, conventional loan, certain loan officers specialize in certain deals. So you're not going to go to a foot doctor for brain surgery. Go to a loan officer that knows the HECM. Go to a foot doctor if you need a foot doctor, not a head doctor. So 86% of seniors want to age out in their own home. And unfortunately, we all know what age out means. But they want to age out in their own home. They don't want to go to a nursing home. They don't want to go to assisted living. And that's 86% of seniors want to age out in their own home. So this is like a forever home. It's not a first-time buyer. It's a forever buyer. Now, if you use forever buyers, they kind of go, wait, does that mean I can't ever sell my home? No, you can sell your home whenever you want. This is a loan like any other loan out there. All it is it has special features. No monthly mortgage payment, optional monthly mortgage payment. If you set up on a variable rate, you have a line of credit that you pay in, you can take back out whenever you need to. So you have money in the line of credit. Oh, taxes are due. You take money out of your line of credit, you pay your taxes. Okay, well, your balance went up the amount of money you owe, but you paid your taxes. And now throughout the year, you pay towards the loan. Oh, your loan's going down, your line of credit's going back up. Oh, your taxes are due again next year. Guess what? You take the money out and you pay your taxes again. Oh, loan went up each year. You decide to make some payments. Oh, balance went down, line of credit went back up. Oh, you take your money out, pay your taxes. As you see, it just goes round and round. Clients can use this tool to gain financial wealth. So not only should your loan officer tell them about the loan, but they should give them options of how to use it so it helps them. Again, you're in this business because you like helping people. You're in this business because you like real estate. And if you help people and do real estate, you get referrals. So a better retirement lifestyle for a senior equals more happy clients. As I said, referrals. So do what is absolutely right for them in retirement. Are you keeping up with the HECM for home purchase now that I've started telling you about it? So if you have any questions, of course, contact your local loan officer. I work for HECM Senior Home Financing. They sponsored me. I donate my time, or sponsored me, to come teach this class for you. But you can talk to any loan officer as long as they know the HECM. Very important. You don't want a guy that only deals with commercial, dealing with a residential HECM. They'd be like, talk to this person. So make sure that you're dealing with what they're dealing with. So we went over before about the senior refinancing this house and buying this house over here that have cash flow. I also gave you another idea earlier that I barely touched on, so let's see if anybody picks up on it. If you buy a duplex, a triplex, or a quadplex, now anything over 4 is considered commercial. It doesn't qualify for the HECM. But a quadplex, they buy it, it's all one property, they live in one unit, they rent out the other 3 units, and talk about cash flow coming in. Seniors with cash flow then turn around and buy another property if they want. They can turn around and go on vacation. They can turn around and help their kids, their grandkids with college. They can help pay off student loans for themselves, their kids, their grandkids. They can do whatever they want. It's their money. So buy the home that's right for them. So how can you as realtor use this to your advantage? Well, we already touched on some of them. So use those clues, features, knowledge bits that you have, whatever you want to call them, to help improve a senior's lifestyle. So as using those things, you get listings, show the listing at half price. Again, how many homes could you sell at half price? How many homes could you sell if all of them are half price? Hopefully all of them. But they are to the senior population. They're half price. Half off. Because they put half in, we finance the other half, and they have no payments. I mean, talk about a win-win. So here comes the next question. Why should realtors market to seniors? Answer that, I'll be right back. All right, again, thank you for answering the question. Make sure you answer them so you get CE credits. So this next slide is an example of how to increase their funding, which I've already touched on, I've already gone over. Again, if they're buying a duplex, buy one, rent out the other, or take a refi and then get a smaller sale, but at least you got a sale. So same thing can be done on the quadplex, which I've already talked about. Buy a quadplex, live in one unit, rent out the other three. Big time cash flow coming in. So that brings me right up to the next question. As I said, this was a real fast 15 questions, sorry about that. But can a senior refinance using the proceeds of a HECM to purchase a rental property? Simple answer, get this one right, and I'll be right back. Great job. As I said, that was a nice and easy one, real quick. So this class is about the morals and ethics of the HECM for home purchase. Do what is right for your client. Basically all that is. So you've heard downsize your whole life. When I retire, I'm going to downsize. Don't downsize just because you've been told that you need to downsize. Nobody really wants to get rid of their stuff. Excuse me. So nobody wants to get rid of their stuff. Nobody wants to just throw away all those memories that, hey, the kids used to play on that table. They see the gnaw marks, that was the dog. See the oh yeah, Johnny jumped off the sofa and banged his head on the table. Whatever the memories are, they don't want to get rid of their stuff. You spent a lifetime accumulating. So you don't want to downsize just because you're told to. Now you may have had a downsize in cash flow because now you're in retirement. But what you can do is right size. Get the house that is right for them. Now, they may not need this house and they may want to go to a smaller house. But they may have a small house and may want to go to a bigger house. Or they may want to stay the same size house. Doesn't matter. Get what is right for them. Now, of course, that's where you guys come in. You find the house that's right for them, then talk to your loan officer. Your loan officer should find the right program for them. Now, if they're a veteran, like myself, then we qualify for the VA loan. They can put $0 down, go in and purchase the home, and then have your monthly payments, stuff like that. Now, you may want to do an FHA loan. You may want to do a conventional loan. Now, when I say FHA loan like that, it's just FHA standard conventional 30-year loan. A conventional 30-year fixed loan. Now, of course, there's lots of loans out there. They don't have to be 30 years. They can be 15, they can be 12, they can be 11, they can be 19, whatever it happens to be. That it's standard forward monthly mandatory payment loan. Now I say forward because they're monthly mandatory payment loans. The HECM, optional monthly payment loan. So first-time home buyers, okay, they qualify to get a lot of their closing costs paid. Most seniors are not going to be a first-time home buyer, of course, because they've owned homes in the past. Now they're just retiring, moving to another home. Most seniors are not first-time home buyers. Now, first-time home buyer, as you know, is anybody that has not had their name on property in the last 3 years. So sometimes you will run across senior that's first-time home buyer. But rehab loans, USDA loans, they may want to pay cash. Of course, the choice is theirs. The HECM, which I'm kind of partial to, is the optional monthly payment loan. But again, do what is right for your client. Let your loan officer help you find the right loan that is right for your client. Now, is the HECM right for every single person? No, of course not. Is bread right for every single person? No, you might be allergic to wheat. But 95% of the cases, like I talked about earlier, Dr. Wade Pfau found that the HECM increases somebody's net worth 95% of the time. So that brings me up to the next question. Is a traditional 30-year fixed payment mortgage best for a client that's 70 years old or older? So go ahead and answer that question. I'll be right back. Thank you for answering the questions. Again, answer the questions to get your CE credits. So what can a senior do with the money out of the HECM? Like, let's say they own the house, they pull out their cash. What can they do with their cash? I've already touched on a lot of these earlier. So I'll just zip through this and then get to the next question. This is going to be real fast from another question real quick. So what can they do with their cash? They can give it to their friends, family. They can go on vacation. They can give it to their kids' health care, long-term care, whatever it happens to be. Remodel the house, pay off the kids' college, pay off the grandkids' college, give it to the kids now rather than wait until after they pass. So go out and see the world. And as you see that cartoon on that slide, I really fought to keep that cartoon in there because I think it was funny, because I did talk to a senior client that her medication each month for one pill was $435 a month. So, and that's after Medicare already paid their portion of it. So until she reached the donut hole, of course. But for $435 per month, we all, unfortunately, a lot of us end up taking some type of medication as we get older. But to be able to have the financial freedom is most important. So as I said, that brings us up to the next question. Can a senior leave a living legacy by using a HECM? So go ahead and I'll be right back. Thank you. And why do we help seniors? Well, just because it feels great. It makes us feel good. By helping a senior get into their home and get into where they want to be, it should be a reward by itself. Now, of course, we all like to fatten the wallet, and we all like to pay our bills. We all like to go on vacation. We all like to do what we like to do. Me personally, I like to take vacations, but you all like to do what you want to do, whether it's playing at home, whether it's moving to a new house, whether it's buying another house, rental property, whatever it happens to be. But the best thing is you're doing what's right for your client. You're putting a senior in the right home for them. Now, if you put a senior in a 30-year mortgage and they're already 70 years old, odds are they're not going to live to see that mortgage be fully paid off. Now, the great thing is, a HECM is just like any other mortgage. You're allowed to move whenever you want. You just take whatever is owed at the time and pay the bank back. So, like every other mortgage out there, you take whatever is owed at the time, the bank gets that portion, you get all the rest. Now, I'll give you a quick example of that. If a veteran saw this home and said, "Oh, that home is awesome. I'm going to buy it. It's $200,000 in cash," and boom, they go in and buy it $200,000 in cash. $200,000 in cash. And before they even get a chance to move in, somebody comes, knocks on their door. "Hey, I really want to buy this house. I meant to get it. I just missed. They accepted your contract first, but man, I really want this house. I'll give you $250,000 right now, even before you move." The veteran says, "All right." Now, he financed it 100%. So now he's turned around and sold it for $250,000. Who gets that other $50,000? Does the bank get it, or does the veteran get it? The veteran, of course, right. So it's the same with every other mortgage too. That the bank only gets what they've lent to you, plus any interest or any fees, anything that you owe like that. And then the rest of it is all yours, or all your clients. So the veteran financed $200,000, they turn around and sold it for $250, that $50 is theirs. If they did a HECM, well, they only did half. Then they sold it for $250. Man, they just made out quick. But here's a good number so you can run them through your head. Really simple. A $200,000 house going up on average 4% per year. $200,000 is worth $208 next year. They borrowed $100,000. Now interest rates are a little bit low, so I'm going to jack it up a little bit and do 5%. Because that's what they used to be. Right now, as I said, historic lows. So 5%, 100,000 goes to 105. So as you see, even with the home appreciating at 4% from 200 to 208, and the home interest going at 5%, 100 to 105, this went up by 8, this went up by 5. You still gained net worth. Your clients still have more in their home to leave to their kids tomorrow than they do today. So you want to do this because it gives the senior a better quality of life. So as I said, this class is sponsored by HECM Senior Home Financing. It's being put on by the HECM Association, which is where I donate my time. And if you have any questions, you see the number right there on the screen. You can call 1-866-FHA-HECM. That goes straight to the HECM Association. They can answer any of your questions. They can help make flyers for your clients, for your listings, not for your clients, sorry. But they can make flyers for your listings. So as I said earlier in that example, I talked my friend into finally doing a flyer. He got 2 sales out of it. I still say he owes me a gift, but obviously you can't do that. But talk to the HECM Association. You can also get info at hecmassoc.org. So that wraps up the CE class. So I'll pause right here for just a second, and then I'm going to tell you a little bit more about how to really increase your sales. All right, that was the last question of the day, at least for the class, that is. So again, call 1-833-FHA-HECM. HECM Association will be happy to answer all your questions. They'll also be happy to get you a knowledgeable loan officer if you need one. Again, I donate my time to the HECM Association because I've been a loan officer for quite a while now. I've closed many HECM deals. So give them a call. Hopefully, if I'm in your local area, they'll refer to me. Otherwise, they may refer to your local loan officer. But thank you, and that brings us to the end of the class. Have a good one.